Hey everyone, thanks for tuning in again to webinar. Taking a little bit of a different tack to this week. I want to sort of run through some slides that I did at a presentation last year on Gann swings, and I think what I'm going to do is split this up into a couple of weeks. This week we'll sort of deal with a bit of the theory and the history, and I'll show you some examples of some signal tests and things that I did using Gann Swing Charts and what they're all about. And then next week we'll get into a little more of the details. Actually, not next week, it'll be 2 weeks because I'm actually in London next week. So what we'll do is just go through this material, want to explain it all and sort of give you a bit of a background. For some of you, you may not have seen much about Gann before, or you may have heard some derogatory comments about it. You know, in technical analysis, there's really two schools of thought. We've got the very objective, quantitative way of doing analysis, and then there's the more subjective way. Now, back in the turn of the 20th century, in the early 1900s, I mean, we didn't have computers to be, I shouldn't say we, I wasn't around then. There weren't computers around to do all the work and create these quantitative models. So a lot of the analysis was done by hand on graph paper and looking for relationships and things like that. I would still say that if you were trading a single security, let's say it's the S&P 500 futures or something like that, having hand-drawn wall charts is still a fantastic way to trade. You get this intimate knowledge of the market. There's nothing like getting there at the end of the day and posting the bars on the graph paper. Yes, very laborious, but some of the most successful futures traders who are just focused on that one commodity, that's exactly what they do and still do it today. And it's a very good strategy for working that way if that's what you want to do. I shouldn't be saying that. I should be saying just use software. But nevertheless, that's the reality of it. But obviously, we at Optuma are becoming more and more quantitative with our signal tester and the new back tester that's in development at the moment. And these are the types of things that we're doing. One of my personal goals is to take all the work that I've done in Gann and learnt about over the last 20 years and make that more quantitative. So do keep an eye out for that as we go over the next couple of years. It's definitely probably a task that will take me the better part of the next decade, but it should be a lot of fun just sort of teasing out and trying to find ways to quantify a lot of these Gann techniques. One of the easiest is the Gann Swing Charts, and so that's why it's one of the first ones that we worked with. So let's just jump in and go in through the material. So a little bit of history for those that not heard of William Delbert Gann. He was born in Lufkin, Texas, in the late 1800s. And the story goes that he was on a train selling cigars and overheard discussions by businessmen who were talking about the trades they were making, and he asked for a job with a broker, and the rest, as they say, is history. What I would say about Gann is that when you hear all the stories and you read about what he did, I mean, I've had the good fortune of going through some of his material that's been held by the Lambert Gann company, and looking at his notes and his charts and things. And while he was an absolute genius, some of the relationships that he had with his family were quite questionable. So I kind of think that maybe today we talk about the Asperger's or autistic spectrum. Perhaps he was on that spectrum. He was really, really smart, but not so good on the social skills. Who knows? But nevertheless, he was a genius. He saw patterns that nobody saw. This was an era where most people, the ticker tape had only just been invented, a couple of decades before. So most people were just looking at the ticker tape and what's the price and things like that. And we've had chartcraft and point and figure charts were getting developed around about that time as well. But Gann came along and he was starting to see things that no one else saw. He was starting to plot the history of prices and saw relationships on those charts. You know, the chart actually behind me here is one of the templates that he would use to draw charts on. So this is an original Gann graph paper, and you can see all the intricacy of the angles and the patterns and everything that he was looking for. I'm trying to get out of the way so you can see that. And he would actually chart his bar charts over the top of that. And so, you know, that was a real, just the way that he did it. He was looking for these type of things. So as you can see, he was definitely a very interesting guy, trailblazing an area that not many people were working at. So obviously he studied many areas. His passion was markets. You know, he looked at different ideas, all the way from the very mundane through to the very esoteric. And, you know, especially in later life, you know, he was very successful early on, but as time went on, he just kept looking and kept finding, you know, many different things. I actually think that his life is a great example of the Pareto principle, you know, that 80-20 rule. I think in the first 20% of his life, he achieved 80% of the success, but then he spent the next 20% of his life, next 80% of his life, just refining things, exploring different ideas. Did they add much? There were some really good things that he found, particularly in the esoteric realm. But did it add much to his earlier success? I'm not really sure. I don't think it necessarily did. But obviously he enjoyed the thrill of the hunt, and so left a bit of a legacy there for some of us to follow who are interested in this. All right, so continuing on, there was a 1909 interview done by Richard Wyckoff for the Ticker and Investment Digest. And in that interview, this is what Richard Wyckoff said. And it's basically during the month of October, in 25 trading days, so probably 5 weeks, Gann made in our presence 286 transactions in various stocks, both on the long and short side of the market. 264 of these transactions resulted in profits and 22 in losses. So this is in front of a journalist and, you know, making a fairly good return there. I think the article goes on to say that he made about 10,000% return in that 25 days. So he's notorious, actually, when you study his life, for making lots of money and then just blowing it all. And you know, he's one of the first people actually in the United States to have a metal aeroplane. Had his own pilot, Eleanor Smith, and he would go and travel over the cornfields because he was doing a lot of wheat trading and soybean trading, and he wanted to see from the air what was going on and using that information. So a little bit of fundamental information as well that he was using, but he was definitely successful. You know, there's some people that say, oh, he died penniless. You know, it's really hard. We just really don't know completely. We don't know what he did with his funds. The only thing we actually do know is that he was in South America, got very ill in the early 50s. You know, was rushed back to the United States, but passed away when he got back. So, you know, again, we don't know exactly what happened to the Gann fortune, but nevertheless, it's still a very interesting topic. A couple other things that he did. So again, I'm just setting the stage of who this guy was. 1929, so this was in November 1928. He came up with this letter. This is his letter, supply and demand letter to his clients. And you may not be able to see this on the screen, but he has a top here. He's basically calling the top in August of 29. Now we know that it was in September the 3rd, so he's out by a month. And he goes on to say that this year occurs in a cycle, shows the end of the bull market and the beginning of a prolonged bear campaign. You know, when we're talking about a 10-year downward bear market, we can give the guy a month leeway either side on that. The year 1929 will witness some sharp, severe, panicky declines in many high-priced stocks. And we all know what happened in 1929. So it's quite amazing that, you know, he was doing this based on his cycle work and different things like that. So truly he was a titan of technical analysis. Just very interesting, you know, the way that he worked. And it's worth spending time researching if you have any interest in this. Would I throw away quantitative methods? No, I wouldn't. I believe very much in the statistical way. For 21 years, I've been working with Gann traders. And while I really believe in these methods, and I believe in a lot of what he did, and I think there's some fantastic things that we can do there, I do believe that the subjective method of trading is very, very difficult. We need to have hard and fast quantitative rules that we can use, or at least objective rules. Now we may, you know, have the filter as us to sort of say, okay, we're going to make that trade, or no, we're not. But when it comes to testing these and things, you know, objective is always better than subjective, because I know myself, I did a lot of trading on Gann square techniques and did some fantastic trades. When things go wrong, you start second guessing and you're like, well, maybe it's not, and far better that we're able to quantifiably test what we're doing. So let's start with his swing charts, which Gann actually called his master trend detector. Now, if you've ever done Dow theory, or you know, any formal study in technical analysis, you know that the principal goal of technical analysis is to identify the primary trend. You know, and you hear the sayings all the time, the trend is your friend, trade with the trend. And, you know, that's where all that comes from. You know, we want to find out where's the primary trend. We want to use our technical analysis to help us identify that, and then jump on board as quickly as possible, and obviously get off as quickly as possible when we see the indicators tell us that the trend has come to an end. And so that's what this is all about. The Gann swing charts are probably one of the best ways that I've seen of identifying the direction of the trend. And so, yeah, we'll jump in there and we'll go through all of this. So here's a typical Gann swing chart. Looks a little bit strange. You know, we've taken time out. So in a lot of respects, this is very similar to point and figure, where we're only looking at, is the market going up? And while the market continues to go up, we're just going to have one line pointing up, and that's it. And then once we get confirmation that the market's turned down, or the trend's turned down, then we turn our swing chart down. And so the direction of the swing chart becomes a great filter for the trend of the market in what we're doing. So this one here is a 2-bar, and I'll explain what all of that is. But you can see right at the end there that we would say that this market, Microsoft, whenever I took this, which was last year, is up at this time. So obviously, as a bit of a disclaimer that I should have put in the slides there, this is obviously an educational presentation. There's no trading advice at all in this. Use your own discretion. Talk to your own financial professionals if you're watching this and you're thinking of acting on any of this. You know, do your own research. No, there's been no thought given to what your objectives are, and so you do need to speak to your own financial advisors about that. Continuing on. So here's a 2-bar swing chart again, but this time what we're doing is we are overlaying it on top of a bar chart. So this lets you see a little bit more about what's actually going on. And you can see here that you know, we've got the swings coming down, and then we get the signal to say the trend is up. We get a bit of a retracement there, up, retracement there. So this is really good because we can see the primary trend here, or there's probably a little bit short term to call it primary, but nevertheless, we can see the primary trend here and the short term reactions that are breaking up that trend as well. So it allows us to be able to see those. So the swing chart ignores time. It's only dealing with the direction of price. Is it going up or is it going down? And that's it. So let's have a look at how they are constructed. Now, in Optuma, if you're using the software, we have a color scheme. So if you click on the bars, there's a color scheme called Swing Relations. And you can use that, and it'll color the bars using this paradigm. So the first thing we want to do is look for higher bars, or identify higher bars, lower bars, inside bars and outside bars. So a higher bar here, that's where it has a higher low. So compared to the bar before, all of these are just a direct comparison to the previous bar. So compared to the bar before, we've got a higher low and we've got a higher high. For a lower bar, a lower high and a lower low. This one's only just lower. Then we have two other cases. We have the outside, where it has a higher high and a lower low. And then we have our inside, which has a higher low and a lower high. And so it's these relationships that determine, the building blocks, if you like, of the Gann Swing Charts. So we've got those ones there, higher, lower, outside, inside, and we colour all those bars by type. So for the swing to turn up, we need to have a higher bar. So when we get, in the most simple one bar swing chart, we have the one higher bar is what will turn that swing chart up. And of course, a lower one will turn it down. Inside bars are ignored mostly. There are some cases, in a one bar swing chart, they're completely ignored. In multiple bar swing charts, which we'll talk about in a moment, we can use a inside as part of the count, and I'll explain that. I'll show you an example of that in a moment. And then, of course, the outsides are undecided. So there are two schools of thought on how to deal with outside, because an outside bar, the way we treat it is that it's a higher bar and a lower bar in one. And that's then what we do. But we have to wait for the very next bar to decide, well, which direction is it going to go? So, for instance, if we had a higher bar here after this outside bar, we make the assumption that we had a lower bar first and then a higher bar. And so the swing would come down to here and then go up. But if we had a lower bar here, then we make the assumption that we had the higher bar. So the swing would come to here, go up to the top. We had a higher bar first, and then we had the lower bar, and it would go down. Now, another way that some people look at this is just to look at the relationship of the open and the close of the outside bar. So if you were doing that, and I think in Optuma we call it the outside bar method, rather than the next bar method. We look at this and say, all right, close is lower than the open. We're going to assume that it went high first and then went down. If it was the other way around, the close was higher, we assume that it went down first and then went higher. So if we are building, so for instance, if we are building a weekly bar from daily bars, then we actually analyse the bars inside to get an idea of what came first. And so we do that work as well. So you can see it sort of change a little bit in Optuma if you're using the outside bar method, but that's why. If we have the lower time frame data, we will use that to get an accurate picture of where that swing actually went. All right, so swing is up and we have an outside bar. So here's an example where we've got this swing going up, we suddenly get this outside bar, we have to wait for the next bar. We know that it's two bars in one, it's a higher bar and a lower bar, but which is first? So we wait for the next bar, along comes a higher bar, so this bar here, higher top, higher bottom, compared to the outer bar, the outside bar. So what we do is we mark the swing as having turned down first and then going up to the top of our new higher bar. Again, another example, if we'd done that and then we get another outside bar, we wait. This time we've got a lower bar, so we say that the top of the swing went from here over to the top of the outside bar, and then it comes down. So the beauty is you don't actually have to do any of this work. It's good for you to understand how this is constructed, but the software obviously is going to do all the work for you and make sure that you don't have to worry about doing that. And that's the same whether you're using Optuma or whether you're using the Optuma Gann Swing module in Bloomberg. Same thing there on both. So we take care of all of the complexity of that. And so we do that, we're turning the swing down. All right, so if we took that, now this is a 1-bar swing chart, and we're getting the history of Microsoft here. We're talking about a year of data there. You can see how noisy that is. You know, there's a lot of jumping up and down, and so it becomes really, really noisy to look at a 1-bar swing chart in this way. So what we often do is we actually use multiple bars. Now here is a 3-bar swing. Now what we mean by 3-bar is that for the swing to turn up, we want 1, 2, 3 higher bars in a row. And when we get that, then we say that the swing is turned up. And so you can see how that has gotten rid of all of that noise, and it's made it much, much easier. In some respects, the higher bar swing charts are really nice for determining primary trend versus secondary trend versus short-term trend. And you can use different lengths for identifying each of those if you're wanting to do that. But as I said, you can see how much cleaner that is. So let's explain the concept of the multiple bar swings. In a X number of bar swings like this, so we've got a 2-bar swing here, we require 2 higher bars for the swing to turn up. Now remember I said with the inside bars that we mostly ignore them. Well, this is the one case where we don't ignore them and we actually do use them. So we've had our swing coming down, we need 2 bars to turn up. So our first bar is an inside bar, and we actually do count that. We count it for as part of the count because it is a change in trend in some respects. If the trend's been going down and we've had lower bottom, lower bottom, lower bottom, and suddenly we get a higher bottom, well, we may not have had the higher top, but it really is quite possibly the start of a change of trend. And so then we wait, and in this case we've got an outside bar, so the swing would go up. We've had a 2-bar count, and then obviously went down. So it wasn't a great indicator of a change of trend, but nevertheless that's how this one worked. Inside bars are the first bar in the opposite direction. In this case, we treat the outside bar, because it got followed by a lower bar, we treat it as a higher bar followed by a lower bar. And so the swing went up and then down. In Gann's original course, he talked a lot about 3-bar swings, and if you read some of his original writings, he talks a lot about 3-bar swings, and that's what he would use. But what's very interesting is Robert Krauss. This is a book that he wrote in 1998 on swing trading. If you're really interested in swing trading, this is actually a really good book to read, a lot of the different setups and things like that. But he prefaced this book with a letter from Gann to Joe Rondinone. Now, Joe was, as far as we understand, Gann's last student, the last student living at the time. I think he's passed away now. But he had all this material that Gann had sent him over the years. And there was one thing that came up, and this is what's reproduced in the preface of that book. Gann had this habit, you know, he would send people his courses, but then if he changed his mind over the years, he would then get a purple pen and write in it, you know, different information. Now again, this may be hard to see, but at the top here, what I find funny is that he's talking here about, you know, you should keep a 1-cent chart of the market. Now, probably back in the 20s and 30s, the market wasn't moving so fast. So yeah, you could probably hand chart a swing chart on a 1-cent chart. But even by the time he sent this to Joe, he just said, don't try to keep this up. You know, just say, obviously just too much work. But nevertheless, this one down the bottom of the page, I've just called it out here. He's talking about using 3 bars. In the original notes, he's talking about 3 bars. But then he does this note saying, use 2-day charts. I don't know what that word is. Ruler, I'm not great at reading cursive. But he goes on to say, better than 3-day, and then signs a W.D. Gann. So obviously in his final letter, the last letter that we know of that he sent to anybody on this topic of swing charts, He himself said 2-day swing charts are better, and we will do some quantitative testing in a minute to show you what we find on that. So just quickly comparing 1 bar to 2 bar, just to make sure this makes sense. We've got our swing going up. Here, this is our 1 bar. You know, obviously the outside bar, which is, because it's followed by a higher bar, is a lower followed by a higher. So it turns the swing down and then continues on. In this case, with the 2 bar swing, you can see that it didn't turn it down. So it acts as a form of confirmation of saying, okay, well, we want multiple bars to really confirm a change of trend rather than jumping in and out too quickly. All right, so breakouts. There is one caveat to this, and that is that if I have a previous swing, so if we take this example here, we've got our swing coming down, we're going up, and then we get 1 bar that took out the bottom of our previous swing, then we call that a breakout. And you know, the 1 bar, we don't wait for 2 bars in that scenario. That is a change of trend immediately. And so that changes the swing on a single bar. So that's the one example with that. Outside clusters, you know, the hardest case, and it took me probably 10 years to get this all sorted out, is when you get outside followed by inside followed by outside, and you've got this cluster of all these bars. And I think the worst case we ever saw was about 5 or 6 bars in a row where there was no clear higher or lower. And so we had this cluster of all of these bars, and it's like, well, how do we process that? And even Gann's writings were a bit silent on this type of stuff. What we ended up doing was saying, okay, well, let's just treat them all as 1 bar. So in this group, we'll take the highest high out of the whole group as our highest level, the lowest low as our low, and we'll keep that as 1 outside bar and wait for a breakout either way. So you can see here in this example that we have outside, outside, inside, and then we finally get a lower bar. And so we go to the highest point in the cluster and then come down from that. So we treat them as a group and look at the highest and lowest. All right, so when does the trend change? Now, the most simplistic way of looking at swing charts is, well, whichever way the swing chart is pointing, well, that's the direction of the trend. It's not actually what Gann did. What he was waiting for was a bit more confirmation. So he would have this idea of, let's get the swing coming in. So we've got our swing charts gone up, and he wanted to see the first pullback or the first retracement. And then after that, once it took out this high where this dotted line is, then he would say the trend was up. And so we're looking for that break of the previous swing high. So as I said, in this case, it's only when that dotted line is broken that we would say that the swing is up here. And then continuing on. Now there is, well, this is an example of the kg charts in Optuma. Now kg charts, again, a swing style chart, uses points and percent rather than bar relationships, but it colors it exactly. I actually want to create this color scheme for all of the swing charts of just one of those projects that I've got to get around to. But you can see, if we take this example here, where we've been up, we've had lots of inside movement actually, but the swing doesn't actually change until we take out one of the previous lows, which we did right here, and then it stays red to say the trend is down until we take out a previous swing high, and then we say the trend is up again. And so you can see that it's a nice way of being able to classify that. But from Gann's technique and Gann's perspective, this is what he would say is uptrend versus downtrend. When it's green, the market's in an uptrend. When it's red, the market's in a downtrend. And that's the way that he would work it. Now, again, when would you buy? Well, if you were buying this, remember this is an educational seminar. Don't go and buy just because I'm saying this. Do your own research and testing. The aggressive strategy would be to buy on the change of trend. So as soon as you cross that dotted line, you're in. Particularly if this point here was 50% of this move up. That's probably one of the stronger trades. You know, Gann talked about it. There's been a number of teachers in Gann who would advocate that type of strategy, where you wait for this to be in that range, around 50%. But once 2 is set, then we enter on the break of the dotted line. As soon as we're over that, that's where you could put in a market order or a limit order, I should say, at that price. So what we want to do now is quantify that and say, okay, well, how would we go? Now, many of you will have seen our presentations on Signal Tester. If not, go to the optuma.com/proweb, which is where we have all these webinars. You're probably watching it on this page right now, but if not, go to that page. Down the bottom, there's 3 webinars that I did on signal testing, explaining all of the reasons why I prefer to work with signals rather than traditional backtesting, really highlighting the pitfalls of traditional backtesting. It's not to say backtesting is not important, but it's not where I start. I always want to start with signal testing before I go into backtesting. So here is the signal. So we've basically quantified this, wrote some rules up and said, I want to know when that previous swing top is taken out, and that is going to be my signal into the market. So let's say I want to find out all the times that has happened over my test period. Again, you want to know about my test period, watch those other webinars. And let's get the results of that. So here again, we're doing the S&P 500 stocks from 2001 to 2009. We're looking at this. I'm testing over 126 days, so 6 months is what this is, because this is trading days. The reason I do 6 months, I think, again, most of you, if you've seen me do this, I'll be doing 21 days for 1 month. 1 month is great when I'm trying to capture a mean reversion idea and short-term gains. What we're doing with Gann Swings is trying to capture the longer trends. And so because it's trend capturing, I need to be out at 6 months to be able to see whether I'm really getting some alpha over the market or not. And what you can see here, the green line is the performance of our signal, all 3,177 of them being averaged up. And here is their average performance, 6.2%, 6.2% over 6 months, while the market stays essentially flat. So that tells me that I've got some nice alpha. I'm doing better than if I just had a buy and hold strategy at this point. 57% probability of gain, that's actually not bad at all. You know, from a quantitative point of view, anything that gets us up around 60% is great. Really puts the odds in our favor that when we go to market again and again and again, that we're doing, you know, really well. The Monte Carlo here, not as impressive, because whenever I do Monte Carlo, I like to try and get to 1 year. So I can kind of use Monte Carlo as a proxy for annualized returns. So I'm only taking 2 signals. I'm randomly picking 2 out of the 3,000 signals, compounding those returns, but doing that 20,000 times. And so that's where we get the Monte Carlo there. So not a bad result there, good return. Reward to risk, not fantastic, you know, 3 to 2, something like that. But nevertheless, you know, you can see those results. So not too bad, just using a very simple Gann-based rule there. Now, if I was more conservative though, and again, this is one of the things that Gann wrote about, was to say, well, once that's established, I would wait for the next pullback again. So this number 3 here, and then as soon as that bottom is established, this line here, the swing turns up, then I'm in on that one, and that becomes my signal. So as I said, it's more conservative, but we can, you know, we can look at that. So he loved to buy on pullbacks, and he'd enter once that 3rd swing bottom was set. So again, here I'm doing it quantitatively, created a show bar in Optuma so I can test it. Whenever I do signal testing, I want to see my signals on the chart first and just visually observe, does this make sense? Am I actually capturing on the chart what I think I should be looking at? And so that's what we've done there. All right, so looking at the results of that, we've got slightly less. We were 6.2 before. We're now at 6%, but our probability of gain has gone up. So as we said, it's more conservative. Now I think the loss in return is a function that we're waiting longer. So the market's gone up higher before we've jumped on board. What makes sense to you is totally up to you. It depends on your risk profile and that, whether you're happy to use some money management. And remember, this is completely unmanaged. If I put in a stop loss, maybe I'd be getting better results, and you can experiment with these things. But where we had 3,700 results before, we've got 17 now. So we're dealing with about half the number of results. And 1,700 trades in about 8-9 years, that's not too bad at all. So very manageable. But again, good returns over the market. Monte Carlo again. It's not the typical Monte Carlo I would do when I do monthly tests. I would always do like 10 to 12 Monte Carlos, and that gives you a much better idea. If I use this strategy again and again and again, what can I expect to be making out of that? But definitely nice. This is right up at 60%, right in where I'd like to see a probability of gain, because that's definitely much better. So adding that level of confirmation has helped that signal as well. Can we do better? So there's some people who will use MACDs and moving averages. We can use them. We can also look at a weekly Gann swing chart. So all of this has been done on a daily basis. But if instead what I do is also add as an extra filter that, well, I'm only going to take my daily signal if the weekly swing is up. It's a way that I can use 2 time frames to confirm what I'm doing. Now, if you watch the presentation that I did with Kirk Northington on volatility-based support and resistance, you'll see how he talks about that some of the best signals that he's ever gotten with the VBSR tools are when daily and weekly are confirming, and that you've got this support zone both on a daily basis and a weekly basis. It almost makes that support level impenetrable. A bit of a tongue twister there. So that's the same sort of concept here. We want to use the higher time frame and say, well, if the weekly swing is up, this may be a short-term downtrend move that we're capturing with the swing charts, and we have much better probability that it's going to continue going up. So let's just have a quick look at that. Here's the signal, the example of the signal that we're using. We want the MACD to be rising in this case, and we also want the weekly swing to be up. So this plot down here is just showing me the times where my weekly swing is up, and I can use all of that to build this signal. And then let's jump in and have a look at those results. And so here again, now we're running at 7% gain over 6 months. We're halved the number of trades again. So now this is really manageable. We're probably talking about 80, 90 trades a year out of this one. I do want to be careful. When I get below 1,000 signals, I start to worry about the validity of the statistics, because you really want to have around 1,000, 2,000 signals to be working with. Once you get below, definitely below 500 is just not enough. We want to be up higher than that. Probability of gains gone up again, only slightly, but still we're in that 60% range that we're looking for. 7% return over 6 months, annualized at 14.7% using the Monte Carlo. So all in all, this is good. We're now running 2 to 1 on reward to risk. So it fits the profile that I'm looking for there as well. So all in all, by adding those extra couple of tweaks, the MACD, the weekly, we've got a much better signal that we can be comfortable with. And of course, there is so much more that we can do. We could be looking for swing gaps. It's another thing that Gann talked about, where the swing gap is when you have the high here, and then it comes up, and then we have the low. But there is a gap between this high and this low. Now we could easily search for that as well and use that as part of our signal and say, okay, well, let's take that and something that we can jump on a lot quicker than that. So obviously there's so much more that we can do with swing charts. I'm very mindful that we're already sitting at around 40 minutes on what's supposed to be a half-hour webinar. So next time, in 2 weeks' time, we will dig in a little more with swing charts. I want to talk to you about how I use this to create a breadth measure. Because at the end of the day, you know, advancing and declining for market breadth, what we're trying to do is say, well, how many stocks are advancing, how many stocks are declining? And there's so many indicators with volume, with price and new highs and new lows. Well, one of the things I did a number of years ago is work with Gann Swings as our driver to market breadth. So I'll take you through the exercise. Next time will be less theoretical and we'll use the software. And sort of explain some of these concepts as we go, and just some of the other ideas and some of the ways that we can test ideas as we go. So thanks for watching. As always, if there's anything we can help you with the software or with scripts or anything, just let us know. And you know, we're more than happy. Just go to help.optuma.com and submit a ticket in there. Thanks again for watching. Bye-bye.